Hello and good evening, and this is Jared Lopez from Next Generation Trust Services. We're presenting today. We're doing a joint presentation. Myself will be speaking about self-directed retirement plans, and I am joined with Patrick Collins, who is the Senior Asset Manager for Gold for America, and he's going to be discussing using your retirement plan to invest in precious metals. Now, I'm going to be giving a brief 10 to 15 minute portion, and that portion is dedicated strictly to self-directed retirement plans in general, and then we'll get a little more specific with Patrick speaking about precious metals after that. To start, we're going to discuss what Next Generation is. Next Generation is a third-party administrator, and we are record keepers for self-directed retirement plans. So you need to think of us basically as a bank. Can we start over? I'm sorry. Is there a way you could stop it? Hello, and thank you for attending this webinar. Tonight we're going to be speaking about self-directed retirement plans, and more specifically, investment in precious metals using a self-directed IRA. I'm Jared Lopez, Sales and Marketing Coordinator for Next Generation Trust Services, where we handle self-directed retirement plans. With me on this joint webinar is Patrick Collins. He is the Senior Asset Manager for Gold for America. So I'm going to be giving a brief 10 or 15-minute presentation on self-directed retirement plans as a whole. After that, we're going to get a little more specific, and Patrick's going to be discussing precious metals. To start, we're going to let you know what Next Generation Trust Services is. We are third-party administrators for self-directed retirement plans. What that means is when you want to invest in non-traditional assets using an IRA, you would come to a company like Next Generation Trust Services. We're not a bank. We're not a financial planning service. I actually have people call me up every day asking, what's the best real estate market to invest in? What should I invest? Should I invest in silver or should I invest in gold? We don't do that. We can never, ever endorse or recommend any product or investment. You need to think of us sort of like a Fidelity, sort of like a Charles Schwab, but at one of those bigger banks, your IRA is invested in stocks, bonds, CDs, mutual funds, all those traditional assets. We do not do any of that. We're only strictly the non-traditional. And the reason that they would invest in non-traditional assets is to diversify their portfolio. A quick disclaimer, again, I can't say it enough, we do not endorse or recommend any product or any company or any service. Even though we are doing this joint webinar with Gold for America, we are not affiliated with them in any kind and in any way. All the information that we provide is strictly for education and to let you know what you can and cannot invest in using your retirement plan. There are several types of plans that can be self-directed. There's the traditional IRA, and of course that's for tax-deferred investing. So any money that you put away towards your retirement plan in this tax year is a tax write-off. However, you will be paying taxes presumably at retirement age when you take out those funds, and you will be, presumably you're going to be at a lower income level at that time. The Roth IRA is fantastic. What that is you pay taxes when you put the money into your plan. So if I made $5,000 and I put that in my retirement plan, I'm paying taxes on it for this year, but the assets and any earnings that go along with those assets are 100% tax-free. So again, if I put $5,000 in a Roth IRA in 2013, and the time I'm ready to retire, it's $1 million. That is all tax-free, and I made some great investments along the way. The contribution limits for a traditional and a Roth this year are $5,500. The third type of IRA that can be self-directed is a SEP IRA, that is for self-employed individuals. It is the same type of plan as a traditional IRA, which is tax deferred. However, the contribution limit on a SEP IRA is much, much higher than a traditional IRA, where with a traditional IRA, you can put away $5,500 for the year. A SEP IRA, you can put away up to $52,000. So it's actually the lower value of 25% of your income for the tax year up to $52,000. The fourth kind of IRA that can be self-directed is a simple IRA. Now that's for small businesses, as well as 401k plans. So there are some big companies that have 401k plans that are entirely self-directed, or you can have a portion of a 401k plan that can be self-directed. And that would come through us. So you would need a third-party administrator like Next Generation to do the asset reporting on the self-directed portion of that 401k plan. There are a couple of specialty plans that are not retirement related that can be self-directed. The Coverdell is for a child's education, and by child's education that doesn't necessarily mean college. It can be room and board, it can be books, it can be school uniforms, anything associated with education for a child can be paid out of a Coverdell education plan, and that Coverdell can be self-directed, so you can invest in non-traditional assets with that plan. And the last one is a health savings account. Now that is a plan that you do need to qualify for. It's only for high deductible plans, and that is for medical expenses. With the health savings account, it is tax deferred going in, and when you take it out to pay for medical expenses, you do not have to pay taxes on it. It's the only plan where it's tax-free. So it's tax deferred when you put it in, and you don't have to pay taxes when you put it out. It's an unbelievable plan. And that plan, any money that you put away towards it, can be invested in non-traditional assets. There are several options for funding an account. Like I mentioned before, the contribution limit, again, on a traditional and Roth IRA is $5,500 for 2013. And if you're over the age of 50, you can put away an extra $1,000. And you can certainly start up your account with a contribution. The next way that you can fund an account is through a transfer, and that's moving between like accounts. So if you have a Roth with Fidelity, you can move it, you can transfer it to a Roth account here at Next Generation. You don't necessarily have to transfer the whole thing. If you want a portion of your retirement plan to go into non-traditional assets, you can set up an account here and transfer the funds from your big bank over to Next Generation. The third way that you can fund your account is a rollover, and that's moving between unlike plans. You see this mostly when somebody leaves a job or gets laid off. They have an old 401k that is just sitting there not doing anything. They can roll that over into a traditional IRA, which is still tax deferred. So there's no tax implications on it. But moving that over from a 401k to a traditional IRA is between unlike accounts. That's called a rollover. And the last way is a conversion. Now, with people, the economy being so bad, people are just making generally less money now. The people are choosing to take a hit on the taxes in this current tax year, just so that their assets and their earnings will be tax-free from here on out. So if I have $50,000 in a traditional IRA, and I know that my tax bracket is going to be lower this year than it is next year or the year after, I can convert that $50,000 from a traditional IRA, pay the taxes on it this year, and then you have a Roth IRA so that the assets that are held in the account and all of the earnings for all of the years to come are 100% tax-free. So we see a lot of this, especially now being December, we see a lot of conversions. Now we're going to get sort of into the meat of the presentation, and we're going to start talking about investments. there are two things that you cannot invest in using your retirement plan. That is life insurance and collectibles. Now, collectibles, arts, stamps, wine, baseball cards is my personal favorite, but also specialty coins or collectible coins. Now, certainly you can invest in precious metals. That's why we're here. That's what we're going to be speaking about. That's what Patrick's going to be speaking about in a few minutes. But only collectible coins are not allowed in your retirement plan. You can hold precious metals at spot price in your IRA. Now, I spoke a little bit about the collectibles that are not allowed, and that includes wine. However, we have a number of clients that invest in a company that trades and sells wine. Now, you think that that may be prohibited, but it's not, because our client's investment is in the company itself and not the wine. So you can invest in startup companies, you can invest in established companies, you certainly can, and if that company happens to trade and sell wine, you can do that. As long as none of the wine goes to you personally, you certainly can invest in a company that trades and sells wine. The other thing that you cannot deal with using your IRA is dealings with disqualified persons. Those people are the IRA holder, the IRA holder's spouse, any ascendants, and any descendants and their spouses are all disqualified from your retirement plan investment. Now, what does that mean? If you own property in your IRA and you're looking to rent it out, none of those disqualified persons can rent out the property. If you're looking to make an investment in a company, none of those disqualified persons can be the manager of that company, can own that company. So there are certain limitations with the investments that you can make within your retirement plan, and we're here to answer any questions that you have along the way. As far as possible IRA investments, anything else that can be an investment can be held within your retirement plan. As I mentioned, real estate, mortgage notes, tax liens, precious metals, unsecured or secured loans, private stock, investments in companies, hedge funds, so much can be held in your IRA. Now, some of the more famous, or some of the ones that stand out in my mind, somebody in the retirement plan actually owns mahogany trees in Costa Rica. So basically, they purchased seeds, their IRA purchased seeds and a 15-year contract, and when the seeds are grown and the trees are cut up and made into our furniture, that is when this person will see a return in their retirement plan. Now, of course, there's risk involved. They need to worry about rain or droughts or what have you, the elements in general, but they are willing to take a risk, and they want to purchase these mahogany trees in their retirement plan. You can also do international real estate. So we have somebody that is investing in a penthouse in Tel Aviv. Absolutely fine. Of course, they wouldn't be able to stay in it at all. However, the rental income that is generated goes right back into the retirement plan. The most popular investments nowadays are real estate and investments into private placements, but the big one is real estate. With the market being so down, people are owning properties outright. They can loan money to real estate investors and secure it by the property that is being rehabbed. There's so much that you can do in your retirement plan. That's the end of my presentation. I'm going to leave you with Next Generation's contact information. You can call the office. You can call me. My name is Jared Lopez. The number is 973-533-1880. Or or you can email any questions to info, that's I-N-F-O, @nextgenerationtrust.com. And I'm going to pass it along to Patrick Collins, who is the Senior Asset Manager at Gold for America, to discuss precious metals in retirement plans.
Alrighty there. Thank you so much, Jared, for the warm introduction. And it's interesting. I've been once again. My name is Pat Collins. I'm with Gold for America. I'm the senior asset manager with the firm. I've been in the industry for 9 years, and I just learned a couple things from you, Jared. So thanks for that. Part of our core philosophy here at Gold for America, and truly one of our core beliefs, is that we believe one of the most effective investments one can ever make is that of their financial education. And so therefore our intent today is to first and foremost provide value, and then second, to do so by presenting information that will support you in being more well informed about the direction we're headed economically, not only here domestically, but as well around the world, and as well to empower you to take action if what you hear today makes sense to you. So with all that being said, let's get right into it. My first slide here is we're going to basically share with you the very simple steps and mechanics of how one would go about holding physical precious metals inside of a self-directed retirement account. And then moving forward, we'll cover all of the fun reasons why on the reasons why one might want to do that. Now, as you can see here under number 1, first you'll need to establish a self-directed IRA if that's not something that you already have done, which consists of completing and submitting a basic application. Now, the key here is to make sure that you do so with a firm that allows investments in precious metals, such as Next Generation, for example. Now, to fund the account, you can either transfer funds from an existing IRA, you can roll funds over from an old 401k, or even one that you're fully vested in, or you can also fund a new account. And then lastly, for step 3, we support you in creating a combination of the gold and silver that will help you to most effectively reach your financial or retirement goals. Once this is complete, your metal is then shipped to the Delaware Depository Services Corporation, which you'll see here in the next slide. And a couple of key points that I'd like to mention here are that your metal is always held in a segregated safety deposit box, and that's under your name as well as your account number. Your metal is never commingled with anybody else's, and also it's insured to $2 million by the Lloyd's of London. And then one last thing that I always like to mention at this point as well is that DDSC is in no way affiliated with the government nor the banking industry, so no need to worry there. Now, our next slide, we're going to get into the good stuff, the meat of the presentation. So some of you here might be thinking, why would I invest in gold and silver with the stock market at all-time highs? And that's absolutely a legitimate question. So let's take a look at some facts here. Since its bottom in 2009, the Dow is up 143%. The S&P, since its bottom in 2009, is up 165%, and the NASDAQ is up an astounding 213%. In fact, just this year in 2013, the Dow has set its 38th record high. And we've also recently just broke through the 16,000 point mark. Now, to be fair, let's take a look at the last time we saw a movement in the market comparable to what we're seeing today. The last time we saw the market move as it is today was back in 2007. Prior to that, back in 1999. Now, in 2007, the Dow hit a record high 34 different times. And that was prior to it falling by more than 50%. And like they say, the bubble is always the biggest right before it bursts. And so pretty interesting data that we have here. Now, let's take an objective look at why is this happening? Why is the market where it's at? Why is it doing as well as it's doing? Is the market where it's at right now because unemployment is low and our economy is thriving and we're producing as a nation? I'm not going to answer that. I'll allow everybody listening here to answer that for themselves, but I think not. The only reason that we believe that the markets are where they're at currently is it's quite simple. It's due to government intervention, or a fancy phrase that's been coined, quantitative easing. Now, QE, or quantitative easing, is nothing more than the creation of currency and out of thin air. In 2008, the U.S. had a total of $800 billion in circulation. Now, mind you, it took 200 years to create $800 billion in circulation. Now, over the next few years after 2008, through operations like QE1, QE2, Operation Twist, and now we have QE3 to infinity, as there really is no end in sight. We have more than, in the last 5 years, quadrupled the amount of currency in circulation. So, in essence, in the last 5 years, being that it took 200 years to create $800 billion of currency, in the last 5 years we've created 800 years worth of currency. Now, on top of that, we're continuing to this day to debase our currency by $1 trillion a year. And it's $1 trillion and 20 billion to be exact, as we're purchasing $85 billion worth of bonds every single month on a monthly basis to artificially keep this whole thing going. Now, it sounds kind of silly after going over the numbers, but do we really believe that this is sustainable? Do we believe that this is something that we can continue to do, to continue to abuse and debase our currency at these unimaginary levels and have there be no consequences or no repercussions? That brings us to our next chart here, which is, let's see here. Our next chart here is the correlation between our national debt and gold and silver. Now, when Bush came into office back in 2001, we were just about $6 trillion in debt. The following 8 years was awash with virtually endless wars in Iraq, Afghanistan, the endless war on terror, and we've managed to, since 2001 up until today, almost triple our national debt. Now, meanwhile, we've seen the price of gold rise from $250 an ounce back in 2001 to just under $12.50 an ounce today. Silver, on the other hand, has risen from $4 back in 2001 to just about $20 today. So for both gold and silver, we've seen an increase of 500% for the both of them. And this, on top of that, is on the tail end of a significant cyclical correction where they've both pulled back quite a bit over the last year and a half. At their peak, back in 2011, gold was up by 800% from 2001, and silver was up a staggering 1,200%. So what does our current debt situation look like? What's currently happening with our national debt as of right now? Well, in the first 6 weeks of fiscal year 2014, we've issued another $1 trillion in debt. This is the first 6 weeks. Now, another thing I'd like to mention here, folks, is please don't take my nor Jared's word for any of the information that you're receiving here. All of it's available with a couple clicks online. It's public information and it's out there, but it's absolutely outstanding, absolutely astonishing that within the first 6 weeks of fiscal year 2014, we've issued another $1 trillion in debt. Now, currently, we're well over $17 trillion in debt and are every single day, as of right now, borrowing $2.73 billion every single day with virtually no end in sight. And so, once again, it sounds a bit silly to ask, but you know, do we truly believe that this is sustainable? Can we continue at this pace and have everything be okay? Now, this brings us here to our next slide, and if everything that the U.S. is doing is good for the dollar and it is sustainable and can continue without consequence, then why are so many countries around the world right now bypassing the dollar in world trade? One of the main reasons we've been able to get away with what we have been economically for as long as we have is that for the last 43 years, we've been the world's reserve currency. Now, the OPEC oil-producing nations in the Middle East, since 1970, they've priced their oil in dollars. And so anybody that wanted to buy oil, any country around the world, if you wanted to buy oil from them, you had to first buy dollars and then buy the oil that you wanted with the dollars that you bought. And this has created an absolutely tremendous demand for dollars around the world. Now, the dollar, just like any other commodity out there, its value is dictated as well as derived from a simple concept of supply and demand. Now, we are massively increasing the supply of dollars that exists, quadrupling, like I had said earlier, within just the last 5 years, and yet the demand for those dollars is significantly decreasing. The Federal Reserve is actually currently paying the big banks who receive massive bailout funds a quarter of a basis point, so 0.25 of 1%, to hold $1.8 trillion in reserves at the Fed. So that money hasn't been released down to into the system yet, and so therefore we haven't experienced massive inflation. Now, so a couple of examples of how the demand for dollars is significantly decreasing: China, Japan, Russia, Brazil, India, Germany, France, Australia, New Zealand, and even the UK now have either already or are in the process of creating bilateral trade agreements where they'll no longer use the dollar with one another in international trade. Those represent 8 of the 10 world's largest economies. China is currently also making direct agreements with the oil-producing nations of Russia, Saudi Arabia, Iran, and as well Venezuela. The question that I have is, what's going to happen when all of those dollars around the world, which represent 70% of all of the dollars ever created that are held in reserves in the banks of other countries, what's going to happen when those dollars are no longer needed in international trade and they come flooding back home? We really don't think that that's going to be all that pretty. Now, our next slide here. Central banks are intricate and are a very important part in regards to what's going on within the world economic situation right now. They're absolutely at the root of what's causing these economic problems, and so let's take a brief look at what are they doing in regards to gold. Central banks create money. It seems to be very esoteric, but it's actually quite simple. Central banks create money that did not exist before, and then they lend it to governments of the world, which then has to be paid back with interest. If you and I were to do this, it would be considered counterfeiting, but they do it, and it's considered central banking. Central banks over the last 5 years have bought more gold than any other time in the last 50 years. More so, in fact, since any other time since 1964. So they're creating currency out of thin air, and then they're turning around and they're buying physical metal with that currency at a record pace. And so this begs the question, might they know something that we don't? Might they be preparing for something that most of us aren't? Now, to get into all the good news now, the unique features and benefits of owning precious metals: liquidity. Gold and silver are one of and have always been one of the most liquid assets ever known. You can literally put a 1-ounce gold American Eagle in your pocket and fly to Europe and utilize it anywhere around the world. Storage of wealth. Gold and silver have been money for thousands of years. The gold and silver coins or bars that were minted literally thousands of years ago have still retained their intrinsic value. And that brings us to our next point. They've never been worth zero. Unlike the thousands and literally thousands of paper currencies that have come and gone over the last few hundred years, with 34 of them ceasing to exist in just the last 100 years, gold and silver have never been worth nothing. Yet paper currencies or fiat currencies have a failure rate of 100%. No counterparty risk. Unlike currency, it's not a debt instrument to be paid back at some point in the future. It's portable. You can physically store $1 million worth of gold in a shoebox. I absolutely would not recommend that you do that, but it is possible. Hedge against inflation. My parents live up in Oregon. I like telling this story because it's just a great indicator of the value of money. But my parents live up in Oregon, and they have a gentleman that owns a gas station in their small town, and he will accept a quarter for a gallon of gas. The catch, though, is that the quarter has to be minted prior to 1965, when all of our coinage was 90% silver. So that quarter that is minted back in 1964, some 50 years ago, will purchase the exact same amount of gas that it will some 50 years later. And with a currency that has lost over 97% of its value over the last 100 years since the Federal Reserve has been was created, that type of wealth preservation in our eyes is literally priceless. Thrives in times of uncertainty. I think that everybody here can agree that these are probably the most uncertain times that any of us will have ever lived through. And then next, here are the options that you do have to choose from in placing physical metals into your self-directed retirement account. Now, there are some restrictions, not a whole lot, there are some, but like Jared had mentioned earlier, you cannot place collectibles nor numismatic coins into your retirement account. And for that matter, you can also not put junk silver, what it's known as, into your long-term retirement account. And then lastly, I'd simply like to wrap up and thank everybody here for their time and attention. We know that it is valuable. And I'd also like to invite anybody out there that this has created maybe some new insights for you. I'd like to invite you to take action, whether that action be contacting Next Generation or Gold for America, requesting some additional information such that you can be well informed, or even speaking with one of our precious metal specialists. That's it, and we will now conclude the webinar. Thank you so much for joining us, and until next time.